panelists and discuss the role of wealth taxation in the tax mix of tomorrow. Our panelists bring perspectives from EU politics, from policy analysis and advice, from international and national government. So we have a very diverse and rich set of ideas and contributions. Now, as for the topic, as of today, taxation of holding of assets of wealth accounts for a small percentage of tax revenues, at least in the EU member states. And the level and the structure of taxation varies significantly across states. However, if we look towards 2050, there are some signals that point to a more significant role of wealth taxation in the tax mix. Some may argue it's not. And that's why what we want to clarify today with our panelists is whether this is so and why, especially why, and what features a wealth tax may have in 2050. Let me now introduce the panelists very briefly. On my left, we have Aurore LALUCQ. She's currently a member of the European Parliament, where she coordinates the Subcommittee on Tax Matters and has been rapporteur in the legislation of the minimum corporate income tax and also on tax transparency. She co-leads a European Citizens Initiative aimed at taxing the EU's largest fortunes that we will like to know more about later, so as to benefit the ecological and social transition, and also has been active in the think tank and civil society. Next to Aurore LALUCQ is Gabriel ZUCMAN. Welcome. He is currently professor at the Paris School of Economics and runs the EU Tax Observatory that produced a significant report as of yesterday, I think. He's also professor at University of California at Berkeley. He brings his outstanding research and academic credentials, top expertise on distributional issues and on taxation, and also cross-border wealth transfer. Then we have Helen Miller online. Helen Miller is, I hope she can join us. In any case, let me introduce her already. Hello, Helen. Helen is Deputy Director and Head of Tax at the renowned Institute for Fiscal Studies in London. She brings to our discussion her own and the Institute's expertise on tax policy design and on the effects that wealth taxes have on individuals and firm behavior. We have next Cristina ENACHE. Cristina is a global tax economist at the Tax Foundation, also well-known think tanks on tax issues. She currently focuses on the effects of taxation on competitiveness, an important issue that we will address, and also brings us her broad experience of policy analysis and advice in her past positions in Spanish think tanks. And last but absolutely not least, Jeromin ZETTELMEYER is currently director of Bruegel, the #1 European think tank in economics. He brings to this panel a distinguished career in senior positions in the German government, at the IMF and the EBRD, and at the Peterson Institute for International Economics, the other top international economics think tank. So, without waiting for one more second, let me now throw the ball and ask one question that I think may be in the minds of all of us. If you agree, we can go along the order of sitting. And the question would be, well, why or why not taxing wealth? Why is it for revenue raising or for reducing inequality, particularly inequality of opportunity? And an additional question is, maybe the answer depends on country specificities or other choices. So let me open now the floor. Aurore, the floor is yours.
So why taxing wealth? Because actually it's very easy to me to answer this question, because wealth is not really taxed anymore. That's the beginning. I mean, if you look in my country, I'm coming from France, so sorry for my way of speaking English, by the way. In my country has a reputation to have a very high level of taxation. When you look at the real number, I mean, at the effective taxation, you can notice, and I mean, Gabriel and the IPP prove it many times, that there is an inequity when we look at taxation right now. The working class, the middle class, their rate is like, when you make the addition of all the taxes is around 50%. When you go in the very rich people, it's around 20 to 25%. And when you look at the very, very rich people, it's 2%, 1%, sometimes lower than 1%. So this is not, I think, a very good situation for democratic reasons, by the way. This situation is, I think, quite the same in every European countries, because we don't have anymore some wealth tax. We just have one wealth tax that remain, and this is in Spain. And also there is something I think that it is worth to have in mind. This is one of the last OECD study that was showing that labor income was more taxed than capital income, and this is an issue. I mean, and if you want to pay, do not pay taxes, I mean, it's better to be paid in dividends than in salaries. And I found the conclusion of this report very relevant. It was saying basically that different tax treatment of labor and capital income affects not only the efficiency, but also the equity of tax systems. And I think that it affects our democracy, that being rich does not give you a visa to have different rules, to have different tax rules. And there is an expression that maybe is a little bit rude, but that I like, coming from a billionaire, saying that it's not because you have won to the sperm lottery that you deserve to have a different treatment, by the way, in our democracy. So we need to have a wealth tax for democratic reason, for equity reason, but also for economic reason. At some point, we need to be able to have a policy mix at the European level. I mean, we only have a monetary policy. We don't have the capacity to have a fiscal policy, and this is not sustainable, I think, anymore. So we need to have a real budget. This is why we need to have a European wealth tax at some point. And last but not least, if we want to achieve the ecological transition, if we want to have an industrial policy, if we want to have the autonomic strategy, then we need to have some fresh money, not French money. But, or maybe French too, by the way, because we have a lot of billionaires in my country right now. Some of French, for fresh money from French people, maybe it could be a good compromise. So this is why, for all these reasons, we need to have a wealth tax.
Thank you. Let me turn to you.
I couldn't agree more. We need a wealth tax on the very rich, because the very rich have a very big tax deficit. They pay significantly less tax in proportion to their income or in proportion to their wealth than the rest of the population. And this appears very clearly in the growing number of studies that are conducted on this issue, both in the European Union and globally. We summarize the state of knowledge on these issues in the Global Tax Evasion Report that we, the EU Tax Observatory, released yesterday. And the situation is very clear. You look at France, you look at the US, you look at the Netherlands. Today there was a study that was released for Italy, and in all cases you see that billionaires pay a very small amount of tax relative to whatever you want to compare that to, whether you want to compare to their income or to their wealth. The denominator doesn't really matter. It's the numerator of the effective tax rate, which is just very, very low. We see it, for instance, in the US in 2021, where there was this revelations by the US media ProPublica that showed very concretely how people like Jeff Bezos, Elon Musk, some of the wealthiest people on the planet could pay $0 or just a few $1,000s in income tax. And we see it in France, in the Netherlands, in Italy, and in a growing number of countries. And what is the problem? It's very important to understand what the problem is, because once you've understood what the problem is, you've also understood why the solution is a tax on wealth. The problem is that when you're very rich, it's very easy to structure your wealth such that the wealth is going to generate very little or sometimes zero taxable income. That's why the income tax is not enough. In the ideal tax system, there is an income tax, a progressive income tax. There is an inheritance tax for meritocratic reasons. There is also a progressive wealth tax for the very rich. The income tax is just not enough because the very notion of income is not well defined for the very wealthy. But wealth is well defined. Wealth is the market value of the assets that you own net of your debts. So we should make progress towards reforming income taxation, inheritance taxation. All of that is important. But on top of that, for billionaires, for centimillionaires, you need a wealth tax, a tax on wealth itself. The revenue implications of taxing wealth are first order. So we show in the report that a modest 2% minimum tax on the wealth of global billionaires, we're talking about less than 3,000 individuals, would raise about $250 billion in tax revenue globally. This is, for comparison, what the best estimates that we have suggest that developing countries need about $500 billion in tax revenues to face the challenges of climate change. So we're just talking about a lot of money. And let me just conclude with that. Why? Because wealth inequality is high. Wealth is very concentrated at the top end, and it's and the billionaires have these very high tax deficits today. Thanks a lot.
Thank you very much. There are already a couple of issues here that are raised that I would like to address later, but for now I want to say that wealth is already taxed in a variety of ways, and it would be better to focus on understanding why countries have in fact eliminated or the wealth taxes and have larger exclusion for capital taxation in general. Many countries want to support capital formation, and that's exactly the opposite of what a wealth tax would do. Over the last 3 decades, most EU countries have repealed their net wealth taxes, acknowledging that taxes disincentivize entrepreneurship and harmed innovation and also long-term growth. Worldwide, 13 OECD countries have already that imposed net wealth taxes in 1965. have dropped their wealth taxes and now there are only 4 countries in the world that apply a net wealth tax. These are Colombia, Norway, Spain, and Switzerland. Revenues from net wealth taxes made up about 4% of revenues in Switzerland, about 0.9% in Norway, 0.5% in Spain, and 0.4% in France, in 0.45% in Colombia, and 0.18% in France, making up just 1.2% of the total tax revenue from these 5 countries on average in 2021. Additionally, according to an OECD report, wealth taxes can disincentivize entrepreneurship, leading to less innovation and less economic growth. However, the report also suggests that net wealth taxes could spur investment and risk-taking. Essentially, the argument is that because wealth taxes would erode the after-tax return for an entrepreneur, that entrepreneur might engage in even riskier venture to maximize a potential return. However, a wealth tax would be a particular poor way to encourage risk-taking because wealthy individuals could choose to increase their consumption to reduce their wealth. Another recent report also describes a different mechanism through which wealth taxes affect corporate financial policies. The study finds that a significant increase in dividend payouts occurs when a substantial increase in stock prices is paired with a wealth tax. As stock prices rise to the point of substantially increasing the wealth tax bill of controlling shareholders, these shareholders can induce the companies to make a dividend payout. Additionally, these larger dividend payouts are associated with lower levels of subsequent investment. Over the years, countries have repealed their net wealth taxes for various reasons, including economic impact. The French Finance Minister Bruno Le Maire has made it clear that the partial repeal of the wealth tax in France was part of a reform package designed to attract more foreign investment. The French reform package also included a planned reduction for the corporate tax rate, which has been implemented over several years. Given that wealth taxes collect little revenue, have the potential to disincentivize entrepreneurship and investment, perhaps countries should consider repealing them rather than implementing a new one or a new one across the continent. Thank you.
May I now turn to Helen Miller?
Hello.
Hello.
Hello, everyone. Sorry I'm not there in person. So I guess my comments in some ways are going to summarise the argument we just heard from the first 3 speakers. So it's the kind of the exam question of why a wealth tax. I think the reasons that are most often cited in favour are all to do with inequality, and in particular the kind of top inequality. They're not really discussed in terms of raising big revenues for a country. So I agree with Gabriel that 250 billion is big in global terms. It could be big, it's useful money, but in no countries do they raise, they're not the big revenue raisers you use to create revenue. So I think inequality really is at the heart of why people are thinking about wealth taxes. On the why not, the most common arguments that are brought up are all about, as we've just heard, the economic efficiency, that does it affect savings and investments. There's also the administrative cost of burden of operating a wealth tax. So at a very high level, that is the debate that's going to play out. I think that immediately flags that it's really important to get to the bottom of the design of a wealth tax. There's obviously a really big difference between a wealth tax that applies very broadly to the middle classes and the kind of wealth tax that Gabriel mentioned that's just going to be for billionaires. And of course, there's lots of different ways to design income taxes and wealth taxes, and that's going to be key, and hopefully we'll get into some of that today. Where people are attracted to a wealth tax on equity grounds, I thought it was perhaps worth flagging that it's often not simply because there are people who are wealthy. I think that equity arguments come around from a combination of having high wealth levels or wealth inequality in conjunction with a sense that that wealth hasn't been taxed enough. And we heard that from the first two opening remarks. It's a sense that people have got lots of wealth and they're not paying enough tax. And for me, that links to kind of 2 issues that I think are important in this debate that hopefully we'll get to today. One is we need to look seriously at the design of capital income taxes. there are problems that are common across all countries. Effectively, and this is what we've just heard, lots of countries tax capital income at lower rates than labour income. There are plenty of forms of capital income that aren't taxed at all. So capital gains at death is a very good example of that, where often there are no taxes levied on capital gains at death. And that creates a whole range of problems. And I think what I want to highlight for now is that even if we had a wealth tax, I think there's a very, very strong case for properly fixing capital income taxes. So I don't see wealth taxes, by which I mean a tax on stock of wealth and taxes on capital incomes, as alternatives. I think we have to be taxing capital incomes in a more sensible way. And that would get at a lot of the equity issues that have been discussed here. So I think the drivers of those problems lead you to want to fix capital income taxes as well as maybe think about a wealth tax. The other thing I thought I'd throw into the mix for now is the idea of a one-off wealth tax. So I suspect most of what we'll talk about today will be either income taxes or annual taxes on wealth. But we could remember that governments can and have in some cases done one-off taxes, so taxes on a one-off assessment of wealth. If a government can credibly do that, so can credibly make people believe that it really is one-off, and that is a big ask, but if they can do that, then a one-off tax has the attraction of being economically efficient. So the concerns we just had raised about the effects of a wealth tax on stopping investment wouldn't be a concern. So I think the debate about a one-off tax is really all about fairness. So do we think it's fair to retrospectively tax people on their wealth? Of course, that couldn't perfectly offset problems of the past. So the fact that capital incomes have been undertaxed in the past, we can't offset perfectly because some of those people who had those big incomes have already spent them. But to the extent that there is a sense that people have large less sense of wealth that hasn't been taxed as that income has been earned or inherited. We've also had big intergenerational shifts. So in the UK, the baby boomers had lots of housing. That housing has increased in value. We don't tax housing in the UK very well. A sense in which inequality has grown or risen, then I think a one-off tax, a one-off redistribution is worth considering. So I think my big point is really we have to think very carefully about the design of these taxes and throw into the mix not just annual wealth taxes on stocks, but one-off taxes on stocks and the annual taxes on income. But I'll stop there for now. Thank you.
May I now ask you?
Thank you. Thank you so much. So I want to start by saying I'm the only non-tax expert on this panel. So you take everything what I say with a grain of salt, and you might legitimately ask, why am I on this panel? And so the way I answer that question is because probably they wanted someone from a Brussels think tank, and because I generally have the reputation of being sort of a sensible, pragmatic fellow. And so what I've done, I've spent one day trying to read up on this literature, and I will tell you where I come out on this debate. I'm going to put it into 3 points, as always. So first, I'm going to answer the question, you know, what is the motivation? Obviously, the motivation is both to reduce inequality and to raise revenue. But, and this is the interesting point, which I'll come back to at the end, the weight on these two motivations, I think, depends on when you think of this tax at the EU level and potentially feeding into EU-level funds or into the EU budget, or if you think of it at the country level. And so particularly if you think of it at the EU level, the revenue-raising motivation becomes way more important, right? Because the type of tax that is being circulated here, the type of proposal, you know, it raises 1% of GDP maybe, if we're lucky. Well, that about doubles the EU budget. That's gigantic at the EU level. It's not very large at the country level. Second, and this relates to the points that Helen made, well, I think there is a very strong case on equity grounds for using tax instruments to reduce wealth inequality, particularly at the top of the distribution. It is unclear to me, after my one day of reading, whether the best instrument really is a net wealth tax. So essentially there are two contenders here, right? One is the net wealth tax. The other one is a suitably defined combination of maybe a progressive capital income tax, a capital gains tax, and an inheritance tax. And so the way I read this literature is if you compare sort of the ideal bundle of capital income, capital gains, and inheritance taxes that people propose with the ideal net wealth tax, the winner is the former. So the combination of capital income, capital gains, and inheritance. And the reason is that a suitably defined, a well-defined capital income and capital gains tax is better at dealing with increases in inequality, right? Because you're taxing actual returns, so you're stopping the rich from getting even richer. And then the other big argument in favor is that from the perspective of entrepreneurship and risk-taking, it's more attractive because it offers you some downside insurance, right? So if you make a loss, you don't get taxed at all, so it encourages entrepreneurial risk-taking, which is a good thing. By the way, I do not believe that even, you know, the Bernie Sanders version of the wealth tax in the US would have had a catastrophic effect on US innovation, just because you tax at levels that are far too high for the normal entrepreneur to take this into account when making this decision. So I'm sort of, I guess, on the left side of the camp from your perspective. And politically in not believing that, you know, these ideas would really stifle innovation. But if you compare these two horses that are in the running, right, a more income-based or a more wealth-based tax, I think from the perspective of innovation and also effectiveness in mitigating increases in inequality, that the winner is the income-based tax. Now, the big argument against this and for the net wealth tax is the one that Gabriel made, is with somehow Trump, and not only Trump, but all the rich guys and the US, they get around paying these capital income taxes because they reduce their income to zero. They essentially consume out of borrowed funds. So they can, you know, consume a lot, but still they have zero income because they pay lots of interest on their borrowed fund. That sort of trick you cannot do with the net wealth tax, but you could maybe get rid of this tick by taxing unrealized capital gains on an accrual basis, right? So this is the remedy. Now, Gabriel would maybe say, well, that you're already crossing into wealth tax territory when you make that point. Now you are with me, fine, okay? But I'm willing to be with him on that one. For me, it's still part of this bundle, capital income, capital gains, inheritance. So if you do switch to an accrual basis, you can deal with that problem. And then there's this one problem which argues the other way on the ability to evade wealth taxes, which is the problem that Greg Mankiw raised when your co-author Emmanuel presented your proposal in the Brookings panel in 2019, which is, would not the net wealth tax, particularly if it has a generous exemption, would it not lead to a huge incentive to essentially split wealth between family members to evade it? So we have had tons of experiences with evasion of capital income taxes. We also have had experiences with evasion of net wealth taxes, which is why these have gradually been eliminated. But Gabriel's point is that the reasons why people have evaded net wealth taxes in the past are less plausible or easier to mitigate today, because we have much better reporting, because we have much better tax cooperation, right? And so that's a strong argument for trying it again. So the possible objection to that is, sure, we are less likely to see people evade a massive net wealth tax, massive for those to which it applies, with the old tricks, but maybe they will come up with new tricks to evade them, right? Like giving their wife and their kids the wealth. So that is one thing. So overall, I'm not persuaded that this is sort of the best way to go out of alternative instruments. But here's the punchline. If you then think of the political economy of doing this in the European Union today, and if you think of revenue efficiency for the EU as a whole, I think the net wealth tax wins hands down. And the reason is that I think it is practically impossible to implement this optimal combination of capital gains, capital incomes, and inheritance tax in a harmonized way in the EU. It is just a complete nightmare. We cannot even harmonize the most basic things in the EU. It is much, much easier. It's still very difficult, but much easier to introduce a net wealth tax from the top, right? Because it's new. You are not asking member states to change anything. You're not asking them to harmonize anything. You're just asking them to sign on the dotted line, like, Will you allow this to happen at the EU level, right? And very importantly, and this is a huge advantage of the net wealth tax, as Aurore and Gabriel have it in mind, the money that would go to the EU budget, if we do this at the EU level, does not compete with revenue that goes to the member states' budget, because this is levied on a tax base that currently is not taxed at all, or hardly. I mean, the very difficult, the crux, right? The most difficult bit about this whole own resources discussion is that while we could find new tax instruments at the EU level, the tax base, you know, the economy that we are taxing is still just our old, finite EU economy that is being taxed at the member state level. And so the net wealth tax is almost a free lunch, because you're taxing a tax base that currently, according to the numbers of Gabriel, if we believe his tax evasion report, actually escapes taxation. So it is, in a sense, a fiscal Pareto improvement at the EU level. And so this is why I'm ultimately for it, in spite of the fact that, you know, theory, I think, argues against it.
Thank you. This paves the way for a second round, and particularly for the next question to Aurore. I mean, well, let's now go and see. We have seen why or why not. Now, what can we learn from the past? What lessons can we draw from the past as to two main issues? The what, so if we want to tax wealth, what kind of wealth, what assets? And second, whom? Who will be taxed? It is the top, very top, or the middle classes. And for that, let me now try to ask from yourselves, what lessons can we draw from different experiences that you have been more familiar with? And particularly for Aurore, what lessons can we draw from the discussion, the negotiation of the OECD and EU legislative acts on the minimum tax one and on cross-border information, because clearly that bears to the problem.
I think that the main lesson is that when there is a political will, there is a way. Because if you go back, I don't know, like 5 years ago, 10 years ago, when we were talking about having a minimum effective tax on multinational, everyone was telling us, it's not possible. It's never going to happen, exactly for the same reason you mentioned, by the way. I mean, no one is going to want to have this kind of taxes. If one of these kind of taxes is implemented, then we will have less growth, etc., etc. At the end of the day, we have the OECD deal, and we implemented this minimum effective tax at the European level. We managed to do it. And I have to thank, by the way, the European Commission, because they made, thanks also to the European Parliament, of course, but they made a good job. We managed with the European Commission to try to tackle the issue of shell companies. By the way, the Shell directive is blocked at the council level, so member state. And Paul Tong is here in front of me, and I can see he's nodding. If they could do something, it would be nice, I would say. We managed to have a windfall profit tax, also at the thanks to the European Commission and the European Parliament, and we managed to have this deal on the minimum effective tax. We managed to do it despite the unanimity. So this is why I was saying, when there is a political will, there is a way, because it's not easy to talk about taxation in the public debate, because this is not something very sexy. This is not something that most of people want. People don't like to pay taxes. I mean, that's part of life. We can understand this. And we managed to do it despite the unanimity. So this is the main lesson, I think, from my point of view, and because it was my first mandate, so this is my conclusion as a first mandate. When there is a political way, there is a way, and now the next step, is to have a wealth tax at the European level, and this is why we submitted the European Citizen Initiative you mentioned in your introduction. The idea, we were a group of 7, 8 people, Thomas Piketty, NGOs, trade unions, Paul Magnette, and we submitted this initiative to the European Commission. The idea is that if we have 1 million signatures, then the European Commission will have to make a proposal. We managed to succeed the first stage, and the European Commission registered our initiative, which that means that we have the legal basis, that the European Commission has the legal basis to implement something and to propose something. And our proposal is the following. We didn't wanted to go into the numbers. So there is no threshold, no rate that was submitted in our initiative. We just say to the Commission, but with a good legal basis, look, there is a problem of inequality. Very rich people are not taxed anymore. We need some money to fund the ecological transition. So you have 2 options. The first option is the harmonization and the creation and the harmonization of a wealth tax in the member states. This is not the option that I prefer. And the second option is to have a wealth tax at the European level, exactly for the reason you just perfectly mentioned. So I think this is the next step for us, and not only for Europe. I mean, I think we all have the same discussion in every country, in every international institution, at the OECD level, in the IMF, etc. So now the debate is growing, and the lesson from the past is that we managed to do it for the multinationals, so now it's time to do it for wealth.
Excellent. I think it's very, very important to draw the lessons from the historical experience with wealth taxation. Many countries in the European Union have had wealth taxes, and they didn't work well. It was a big political and intellectual failure, to be honest. And there are 2 ways to look at this. You can say, well, we tried some form of wealth taxation in the past, it didn't work, therefore it can never work. And there's another way, which is we can learn from history. We can learn about past mistakes, and we can correct those mistakes. And I think it's, a bit more constructive to try to adopt that view and see how far we can go with that. So what were the mistakes? There was essentially no attempt at fighting tax evasion. Wealth was self-reported. For income is not self-reported. Income in EU countries, it's pre-populated income tax returns where the tax authority says, we know what your income is, here's how much you have to pay in income tax. For wealth, it was not like that. It was, oh, please tell us about your wealth, please be honest, and please pay us some money. And, some people were not perfectly honest and underestimated their wealth, in particular by hiding assets in tax havens. And no effort was made at fighting that tax evasion until quite recently. And then things changed. Since 2017, we have an automatic exchange of bank information. It has made a big difference in terms of reducing offshore tax evasion. So now tax authorities have access to comprehensive information about your wealth, not only domestically, but also abroad, information that could be used to pre-populate a wealth tax return, making tax evasion much harder than in the past. That's number 1. Number 2, the wealth taxes that existed started quite relatively low in the wealth distribution. And because of concerns about liquidity for people who are, for whom most of wealth derived from home ownership, lots of exemptions and deductions were introduced in those wealth taxes, meaning the wealth taxes that existed historically never tried to achieve what I think a wealth tax should try to achieve, which is to tax the wealth of very rich people, but all of that wealth at its market value, not exempting private businesses, not exempting anything. Think of a wealth tax above 10 million or 50 million or 100 million euros. It's self-evident that above that level of wealth, people have a real ability to pay taxes, and that if they pretend that they don't have liquidity, it's because they organize their own illiquidity by structuring their wealth in such a way that the wealth doesn't generate income. Long story short, if you start high enough in the wealth distribution, you can tax all the wealth above that high exemption threshold, no loopholes, and if you have no loophole, it makes the tax is going to work much better than in the past. Last issue, and probably the most important issue, the reason why many countries abolish their wealth taxes is the concern about mobility, expatriation, people moving to low-tax countries. Tax evasion, tax competition, these are not laws of nature. That's the most important thing to understand. They are policy choices. And we can make certain choices that facilitate tax evasion, tax competition, or we can make other choices. The choice that was made historically is that countries didn't try to tax wealthy people who would move to a low-tax country. But other choices can be made. So we could say, for instance, someone who's, if we think of a wealth tax at the EU level, there's going to be a concern that EU billionaires are going to move to Switzerland. How are we going to address that very quickly, because it's really important? There is a concrete solution to that, which is to say, well, if you've lived for a long time in the EU, and you've become very rich there, and now you move to a low-tax country, well, we are going to keep taxing you after you've left for a number of years, maybe not until you died, maybe 10, 15 years we can discuss. But stopping immediately to tax these persons, that's the choice we make, and it's very extreme, and we can make other choices. So bottom line, we can learn from these mistakes, and it's possible to have wealth taxes that will work much better in the future.
Can you jump to Helen to give us her opinion? What lessons can we draw from the UK debates and the experience?
Great, thank you. So we obviously don't have a wealth tax, at least not an annual stock wealth tax, but I think there are three lessons at least that worth highlighting that hold both for capital income taxes and would hold for a potential wealth tax. And actually, the first of those I think overlaps very much with what Gabriel's sort of second point, which in the UK, and I know in many countries, you see clear problems with capital income taxes because different incomes are taxed at different rates. So people switch away from labour income to capital income, particularly capital gains. They delay their capital gains until death to avoid taxes. They arrange their affairs so that they have business property or agricultural land to avoid inheritance tax. So in the same way that Gabriel was saying that other wealth taxes have had problems because they're kind of leaky, you have some incomes that are not taxed, you have the same problem with capital income tax. So I think the big lesson is if you're going to have one of these taxes, an income tax or a stock tax, you really want a base that is comprehensive so that all assets are taxed, that you don't get either the tax avoidance that comes with having different tax rates or the inefficiency of having a tax that drives people to make choices based on the tax rates. However, so I think that's a kind of clear economics lesson there. I thought it was worth flagging, however, that I think there can be a tension there with some people's perceptions of equity. Some of the reasons we have some of these carve-outs, lower rates, comes about because people think it would be unfair to tax so-and-so. So unfair to tax main homes would be a good example. In the UK, we don't tax capital gains on main homes. We have a higher threshold in inheritance tax for main homes. So some of these carve-outs are coming because some people think they are fairer. So there can be overall senses of fairness and wanting to tax things, but then you get arguments for carve-outs. So we'd need a way to stop those arguments happening. I think Gabriel's suggestion was for very rich people, you just you don't worry about it. I think that's fine for the top. If you're having a middle class wealth tax, then I think that would be a bigger issue. Kind of a related sort of second lesson was that taxes can be unpopular even when they only hit very rich people. So in the UK, and I'm sure this is similar in other countries, the UK has an inheritance tax. It's only levied on about 4% of estates. It raises less than 1% of our revenue. There are, main homes, most of them aren't taxed, pensions aren't taxed, agricultural land and businesses aren't taxed. Despite that, the tax is hated. In polls of taxes, it is regularly ranked as the most unpopular tax in the UK, even though most people never pay it, know nobody who's paid it. So I think that speaks to, we shouldn't assume that some of these taxes will be popular, even if they're only paid by the very, very rich. And I think that's partly to do with a sense of, has other taxes already been paid? So in the UK, you get debates about, well, that's not fair because tax has already been paid, even though it hasn't sometimes. So thinking about how people perceive these taxes, and the difference with wealth taxes is people have a sense that it hasn't been taxed already, but maybe that would change if other taxes were higher. It's also the case, it's not just the level of tax that matters. So even people who don't pay inheritance tax seem upset by the idea that it's difficult and time consuming to deal with this particular tax. And some lessons there about how to make top taxes popular. And the final one I thought I'd touch on was just the international issues. So again, Gabriel's already touched on some of these. There are concerns both about capital income flows and stocks of tax. I won't repeat what Gabriel says, but another thing I guess to flag is that collaboration or coordination between countries can clearly help here. So we've heard about the corporation tax minimum deal, there are lots of other examples, but one UK specific one, we have a lower rate of capital gains on people who work in the private equity industry. This will be a debate in the UK in the next year because our opposition Labour Party would like to increase that tax rate. But one issue we're going to face is that although our rate is low in the UK, so it's about 28% relative to a top marginal rate of over 50%, other European countries also tax that kind of income at lower rates. So there's a concern if we move to full top rates, some of that industry might move to other countries. So to the extent that with these taxes you can get governments to agree to have some minimum level or agree to do something harmonised or to have a wealth tax that is common across countries, I think you can substantially reduce or turn off some of those mobility issues. I think there's some of the lessons.
Thank you. Cristina.
Thank you. I just wanted to comment that an exit tax in Europe, as you understand, there cannot be a wealth tax at the European level because people would move out of the European Union. So an exit tax at the European level would mean that it's going to also mean that it's an entry tax. So what you are telling people, successful entrepreneurs outside in the world, that don't come to Europe because we are going to tax you. So neither, I don't know, we would not have a Zuckerberg here, we would not have Jeff Bezos here in Europe because we are going to tax all these people. So everybody, you are transmitting the message that nobody that's a successful entrepreneur, independently how small or big he is not welcome in Europe. So on the other hand, I just wanted to mention that harmonization across Europe will not actually fix the underlying economic flows of the policy. And getting back to Spain, so Spain introduced a wealth tax in early 1977. So it was an exceptional and transitory measure introduced to have a rough approximation of the total amount of net wealth and as a measure to control income tax. However, 46 years later, this temporary mechanism was introduced. The wealth tax is still in place. So I think if we can look at the wealth tax in Spain and if the wealth tax is actually capable of reducing inequality, well, Spain should be, at this moment, after 46 years of wealth tax, should be the most equal country in the world, which is not, of course. So nowadays, Spanish regions levy a progressive wealth tax ranging from 0.66% to up to 3.75% in Extremadura and Valencia. Norway, on the other hand, levies a net wealth tax of 1.1%, barely more than 1/4 of the top wealth tax rate in Extremadura, while the top wealth tax rate in Zurich, Switzerland, is only 0.7%. Nevertheless, with the top tax rate that is 1/5 of Spain's top tax rate in 2021, revenues from net wealth taxes made up to 4.6% of revenues in Switzerland, compared to the 0.5% in Spain. Not happy with these results, with the excuse to finance government support measures related to high inflation, Spain's central government introduced a national temporary solidarity tax on high net worth individuals. This, in fact, is an additional wealth tax that complements the regional one, and taxpayer can credit their regional wealth tax contributions against the national solidarity tax liability. In fact, this solidarity tax was a retaliatory measure against the 100% relief from the tax in Madrid and other regions that followed Madrid's tax policies like Andalusia and Galicia. With this solidarity tax, the central government expected to collect 1.5 billion euros, but in the end, it only collected 1/3 of that amount, 0.6 million. That's about 0.15% of the total tax revenue in Spain. Previously, in 2021, at the regional level, the wealth tax collected around 1.3 billion euros, of which 107 million came from the Andalusia taxpayers. However, this year, the central government collected 1/3 of that amount, only 30 million from Andalusia's taxpayers, while the regional government, having introduced a 100% relief of the tax, collected nothing. Not only the solidarity tax didn't collect the revenue announced, but also 3 regional governments, Madrid, Andalusia, and Galicia, appealed the solidarity tax at the Constitutional Court. On the other hand, Spain is the only EU country that introduced a tax on non-reusable plastic packagings. Bear with me on that because I'm going to explain why I'm introducing this. Okay, just this thing. Okay, so given the revenue trend during the first 6 months of the 2023, by the end of the year, this tax would collect more than Spain's solidarity wealth tax did. Ironically, the national solidarity tax was implemented to offset the cost of living crisis that the government raised by the introduction of the non-reusable plastic packaging tax. Therefore, these taxes do not serve their purpose. They were created for and do not reduce the inequality, as governments don't have a solid redistribution mechanism. That's why Extremadura, one of the regions with the highest wealth tax rates in Spain, has just repealed the wealth tax. Extremadura, one of the poorest regions in Spain and in Europe, also has one of the highest unemployment rates, 17%. So my question is, how was a wealth tax going to solve this problem? It couldn't, because the problem is much bigger than whatever a wealth tax could provide. And it's structurally deeper than just Ricardo Leal in Extremadura having money. Government, therefore, they should focus on reason. Sorry, go ahead.
Well, we have had diverse views. Jeromin, could you provide yours?
I spoke too long in the first round. You might just make maybe one comment on Gabriel. So I think it's. I understand why you focus your arguments on avoiding the mistakes of the past, because that's the first order argument that's made against net wealth taxes. But of course, I would be concerned that we are not able to anticipate new forms of evasion, right? And so if we were to do something like this, I think it would be important, and this is also true for other reasons, to have a mechanism in place that is like a large taxpayer unit type mechanism in place that has some discretion to address new forms of evasion as they arise, and that is probably only feasible if the number of individuals that ends up being taxed is relatively small, right? Because you need to monitor what they end up doing. And you give then the tax authority some discretion to go after behavior that is clearly evasive, but has not been spelled out specifically in the law, subject to some judicial review.
Can I answer just very quickly to that, because it's really important. It's really the crux of the issue. And we had exactly those debates about 1 century ago. just before the creation of the progressive individual income tax, where lots of people were very skeptical that we would ever be able to tax income. Income is very hard to measure. If you have a progressive income tax, there are incentives for people to split couples. There's going to be tax evasion, tax exemption, and a lot of creativity at the time with imagining all sorts of loopholes and problems. We have now a progressive income tax in most countries, and it's not completely perfect. There are problems, but by and large, it's a large success. And I think it teaches us a key lesson, which is what you mentioned, which is that a tax is always more than a tax. When you create a tax, you also create enforcement procedures. You create accounting norms. You create, certain norms that are going to make the tax work if there's a political will to make it work, or that are going to make it fail. If there's not the political will to make the tax work. And there is the example, of progressive income taxation, which is a big success, which makes me personally optimistic about our ability to make a progressive wealth tax work.
I'm off track in my managing the debate, but I want to keep my promise of opening to the audience. So let me now open the floor to the audience here and also to the audience online. The floor is yours. I see one question there.
Capital gains tax, can something be done at the EU level? So if we cannot collect the tax, but all these problems with lower rates among countries, can you do something on that?
So who will take that one?
Helen.
I can do.
Helen?
I can answer if you like. Others here will know more about European Union level taxation. So, on some sense, the problem is one that somebody mentioned earlier, that lots of governments already have capital gains taxes, so you would have to get them to harmonise or give up that taxing ability. That's obviously going to be harder politically than starting a new tax. And the other thing to flag is that a lot of problems arise when people are shifting across tax bases from differences between multiple tax instruments. So different governments are going to differ currently in the gaps they have between capital gains tax and taxes on dividends and interest and regular labour income. So if you're going to try to set a common EU-wide just capital gains tax, that's going to lead different incentives in different countries. And so what rate would you pick, for example? That's going to lead to different problems. So I think the fact that you're starting from a situation where the levels are so different across countries, it's going to be kind of hard to just put that on top in a way that it wouldn't be so hard to just have a net wealth tax. I think my bigger point here is that capital gains tax is a mess in almost every country. It'd be nice if all countries could move towards a more sensible taxation of capital gains, which in my mind would include sorting out the capital gains tax base. So, for example, not taxing inflationary gains and taxing real gains, and then have a rate that was more aligned with other taxes in that tax system. I think that would be easier to do at a country level, given that it's currently at the country level, but I'm sure there are things you could do at a more a regional level if you wanted to.
Thank you. Other replies from...
I would like to mention that many countries have large exemptions of capital taxation because, in fact, capital formation leads to higher economic growth, and this is the reason why capital is taxed less than income taxes. So, in order to compare capital gains tax rates and labor income, we should factor in also all the layers of taxes that apply to the capital gains. Capital gains taxes place a double tax on corporate income, and taxpayers have often paid their income taxes on the money that they invest. Even the OECD report recognizes that when considering taxes paid by both companies and individuals, the gap between labor and capital income taxation is considerably smaller than when considering only personal level taxes. The gap between effective tax rates on labor and capital income varies between countries and sometimes grows with the income levels. In fact, many countries at the low levels of income, the gap between effective tax rates on labor and capital is insignificant. And additionally, in some countries, like Spain and Colombia, the effective tax rates of capital income is even higher than the effective tax rates on labor income.
Okay, thank you. Another question? I see there on the left, on my left.
Hi, I'm Claudia Peseczna from Invest Europe. I have a question regarding the initiative, the European Citizen Initiative. You mentioned that you were not planning to add any threshold to it, but in the end, what would be the threshold? You were mentioning also the billionaires before, so what would you see as a threshold there for the taxing of the wealth? Thank you.
Yes, it's up to the European Commission to decide. That this is sorry guys, sorry. I mean, and I'm sure that Gabriel will have something to say on this, but we didn't want it to have a fight on the number. Actually, we launched this initiative. It was very clear what we wanted. The situation of inequity seems pretty clear to us too, but we didn't want to go into the numbers, into the threshold, into the tax rate, etc. As I always say, when we will be discussing the threshold and the tax rate, we will be in a pretty good shape and situation. And also just to also give a quick answer to what was to the previous question, my political group is defending and supporting taxation on capital gain for obvious reason. And as I said before, nothing is, to me, really impossible at the European level, in fact. So I think that at some point, maybe we will have this kind of tax too. But I don't know if Gabriel will want to say something on the initiative or not.
I mean, very briefly, I think what makes most sense is to have a high exemption threshold. So you don't want to tax the wealth of the middle class for the very simple reason that the middle class already has a wealth tax, which is a property tax. And so you don't want to have 2 wealth taxes for the middle class and 0 wealth tax for billionaires. So you want to have a wealth tax. You know, in the US, when those questions were, hotly debated in 2019, 2020, Bernie Sanders proposed a wealth tax starting at $32 million. Elizabeth Warren proposed a wealth tax starting at $50 million. President Biden has in his budget something that he calls a billionaire income tax, which is neither an income tax nor a billionaire tax. It's a tax for people with more than 100 million in wealth and their stock of unrealized capital gains, which is essentially for most of them, most of their wealth. But so it starts at 100 million. It's above those levels that current tax systems really fail. Because that's when you have tens of millions, hundreds of millions of euros in wealth, that it becomes very easy to report very little income and that the income tax fails.
Thank you. I understand, Joseph. And then may I have also the Slido questions that may have been coming, but please.
Thank you very much. I'm Spanish, but I don't want to to boring you talking about our domestic controversies. My question is, if we want a fair taxation system, we need information, and probably we need a global world register of financial assets, on real estate assets, beneficial owners. But the question is how to build it.
Well,
what do you think?
I think I know who can answer this question.
First of all, I would say that there is a lot of information that governments currently have about the wealth of people. So it's really important to realize the enormous progress that has been made thanks to the automatic exchange of bank information. So 10 years ago, there was complete bank secrecy. It was really easy for people to hide assets in offshore tax havens. Today, banks all over the world are supposed to send information to the relevant tax authorities about the accounts of their customers. And I'm not saying that all the bankers everywhere in the Cayman Islands are all perfectly honest and cooperating perfectly truthfully. That would be maybe a little bit naive, but the evidence shows that there is a considerable amount of wealth, around 12 trillion euros, that's captured by the common reporting standard, and so that's reported annually to tax authorities. Tax authorities also have information about domestic assets, because there is an automatic exchange of bank information between domestic banks and the tax authorities. So there's already a lot that can be used very concretely to pre-populate wealth tax returns should we have a wealth tax next year. So we don't need to wait for a global asset registry. But a global asset registry is, I think, a valuable goal in the long run, because indeed it's not always completely enough to rely on the information that's supplied by the financial industry globally. It's very important, it's critical, but it's not exactly enough, and so it's good to create additional forms of transparency like we've done historically with real estate registries that have existed for centuries, but that we have not modernized and adapted to the reality of wealth today. The reality of wealth today is that a lot of wealth is financial assets, equities, bonds, and so it would make sense to build on the existing registries and just make them more comprehensive to capture all forms of wealth.
Thank you. May I have the slide of questions, if any? Yeah. Oh, thank you. Let me take one from Slido and then to you. Thanks. The question is, how would the perfect wealth reporting good look like? We have learned about self-reporting. We have just learned about the bank reporting and the possibility of one registry. Is there another? Is there more information or additional answers that we can give to this question, or you think that's
I think, no, frankly, I think we've covered that question, so maybe, I mean, I'm happy to elaborate, but I think there might be other...
Yes, thanks. My name is Jan van der Streek. I'm a law professor from the Leiden Law School in the Netherlands. And I have a legal question. Well, actually, I'm really surprised to hear these ideas of, about to create a European tax on wealth levied by the European Union itself from EU citizens. This is something I would never expect it to happen. And it's really, for me, out of the box. So I'm really on the, normally I'm on the progressive side, and I really understand we tax companies because it's related to the internal market. But to tax citizens by Brussels, I just cannot imagine this. Why? Because this is also related to how the EU, how the EU is functioning. Well, we got this saying, and it says, no taxation without representation. The representation is really difficult in the EU because it's a union of member states. So I think it's really far from tax sovereignty of member states to tax citizens, individuals, not companies, at EU level. And I really would like the panel to reflect on these arguments.
So before you leave, can you give your perspective
yes,
on that?
I'm an economist by training. And you know, economists, we don't like we don't like this kind of people that is sitting in front of me, exactly for the reason you you just elaborated. Frankly, I mean, I'm sorry, but I'm not being this kind of argument. frankly, because we are here in a political situation where we have a democratic issue, a social issue, an economic issue, and we need to have some money at some point because we have a war, because we have to achieve the ecological transition, because we have so many challenges. So frankly, the legal basis is a human creation, and I think we can change it at some point. And I think that at some point we will need to change it because it's not possible for us. We manage with the European Commission, we manage with some member of the Council to try to find a way to implement some taxation without using the word of taxation, etc., etc. And we managed to have the windfall profit tax, we managed to have the Pillar 2 of the OECD deal, but come on, frankly, it's not possible to keep on this way. So we need to get rid of unanimity at first. We need to get rid of unanimity, and we need at some point to make sure that the European Union can be able to have something that is common in every democracy, which is called taxation, because taxation is always related to a parliament, by the way, and also to democracy. It's not only an economic or a social issue. So this is why I understand your point, but I don't like it, and I want to change it. And this is my job, by the way. This is my function, so that I'm more than happy to try to do it. But we will need to fix this. This is not possible anymore. We need to have a budget. I mean, we are just like kids playing and trying to find some solutions. Yeah, I'm too long, and I need to catch my train, by the way. But thank you so much.
Thank you. Jeromin?
Okay, the problem is there are no lawyers on this panel, right? But there's a great Bruegel paper, not exactly on this issue, but on a related issue, European Union debt financing, leeway and barriers from a legal perspective, by two lawyers, bona fide lawyers, Sebastian Grunde and Armin Steinbach, basically explains the legal background, the own resources decision, and how this is made. So, I mean, you probably know the answer. When we talk loosely about creating a tax at the European level, it's a parable. Right? It's a shortcut. What we mean by that is unambiguously the treaty puts the power to tax at the level of the member states. Everyone understands this. There is also a mechanism by which member states can use that power to essentially create resources, own resources for the EU level. It requires unanimity. It requires changing this EU own resources decision. And of course, the administration of the tax it would still have to involve member states, right, or the cooperation of member states. But you can, I think, use this mechanism, which sets legally a very high bar, namely unanimity, to create a tax that, for all intents and purposes, looks like a tax that is levied at the EU level. So this is, I think, how we mean it, right? I think you had a... No, you want to stop.
I need to stop, yes.
Okay.
and I know.
I thought Gerasimos wanted to explain the own resources decision. No?
Well, I was involved in one own resources decision in the past, but so may I now ask the panelists and Helen online just to state in 30 seconds, 1 minute maximum, the key takeaways that they see from today's discussion. Gabriel.
I think it was relatively clear. You know, we need a wealth tax because the very rich don't pay a lot of tax. There's a basic fairness issue. There is a basic revenue issue. Number two, it's feasible because we understand mistakes that were made and how to overcome those mistakes. And number three, you know, let's do it.
Cristina.
Okay, so just because something is politically popular, like taxing the rich, doesn't mean that it's sound economic policy. The inequality gap has been caused by many complicated economic factors that go well beyond the scope of what a wealth tax can fix. Tax policy should be focused on efficiently raising government revenue, especially given that Europe faces structural problems like aging population and macroeconomic imbalances, and not be used to fix every social issue. Governments can make welfare payments without revenue, and therefore policymakers should focus on principled pro-growth tax policies that close the inequality gap by making the households at the bottom of the wealth and income distribution better off, and by creating more opportunities for young people rather than introducing a distortive policies with limited revenue potential. In fact, the European Union has a tax that is better than the wealth tax, which is the value-added tax, which can also, it's not that as distortive and can be used to collect revenue at the European Union level, while also raising a lot of revenue, because value-added tax raise around 30% of the general revenue, while wealth taxes only raise 0.5%. So if there's something that needs to be touched, probably that is the value-added tax.
Thank you. May I ask Helen first?
Sure. So I guess the last two speakers demonstrate that I think the debate about wealth taxes isn't going to finish soon.
Not today.
So certainly not today, I'm afraid. But I think what I'd say is that all countries do currently have some forms of capital income taxes. They are almost always poorly designed in that they manage to be both often bad for efficiency. They do have features that are bad for investment, and they create a whole bunch of inequality. So I think we should at least get on with fixing capital incomes taxes to make them more efficient and more and fairer. And that would be a great thing to do, regardless whether we want a wealth tax, because if we fix them all, you could still have a wealth tax as well. I think they're not alternatives in that sense. So I think while the debate about wealth tax is being had, let's crack on and fix capital income taxes today. I mean, let's really start doing that.
Thank you. Jeromin.
Well, I agree with Helen, but I also think the net wealth tax idea, while not perfect, deserves a chance, right? And so I really hope this initiative gets the 1 million, and I hope that Gerasimos will have the incredibly interesting task of then figuring out how to actually design this thing at the EU level. At the very least, it will make extremely interesting reading and a very nice debate.
Thank you very much. All I need to do now is to thank certainly the panelists for a lively discussion, and the audience, with my apologies for not having let you intervene more. Thank you.